It's a good year for stocks, but not so much for bonds. A change in Fed rate expectations for 2025 prompting a sell-off in treasuries. So now the time to buy higher yields, or is more selling ahead? We want to bring in Mark Cabana. He is Bank of America Securities head of U.S. rate strategy. We also have Janet Rilling, Allspring Global Investments senior portfolio manager and head of Plus a fixed income team. It's great to have both of you here. Janet, let me just start with you. When you take a look at the spike that we've seen in yields, clearly the bond market signaling and very much what they expect the Fed to do when it comes to the rate cutting cycle next year. What do you think is mostly driving that upside, and maybe what that signals looking ahead to the new year?
Yeah, certainly we got a lot of information from the Fed at the last meeting. They did have a cut in rates, but it was a hawkish cut. Powell guided the market to a slowing outlook in terms of rate cutting cycle. He acknowledged that growth came in stronger than expected, employment picture was staying more solid, and that inflation was maybe not coming down as quickly as they'd hoped. So I think that's really what caused a large reset for both the Fed participants and the market. So as we look forward, I think one or two rate cuts for next year is sort of a base case. But the market and the Fed are going to be highly data dependent. The Fed has said that all along. And if the data starts showing a bit of a different narrative, if inflation is not moving lower as they'd hoped, I think we have to look at maybe a pause or a continued pause in 2025.
And Mark, jump on in here. What is the bond market telling us about what Janet is saying, particularly when you consider that the average call for the 10-year for 2024 was that we would end around 3.8%. We're obviously ending around 4.5% as it looks right now in the trade. What does that indicate to you about what the bond market thinks about what's next for the macro environment?
Sure. Well, first of all, Happy New Year's Eve. Thanks so much for having me. I think that what the rates market is telling us is that it anticipates that U.S. economic growth is going to continue to be quite strong going into 2025. Certainly, calls for a faster U.S. economic moderation were unwarranted earlier this year. And that's why the rates market has priced out so many cuts from the Fed. It's, again, now pricing in just under 2 cuts for 2025. But the market seems to have relatively low conviction in that and is going to continue to be very, very data dependent, as the Fed will be too. For us at B of A Securities, we anticipate the 10-year ending 2025 at 4.25%, so above where consensus is, but slightly below where we are at this moment. Our house view is still for 2 cuts from the Fed next year, though there's relatively low confidence in those. But we do think that bond yields will be moving slightly lower because we anticipate a bit of a further economic moderation. And we also anticipate that uncertainty about the outlook, what will exactly those new economic policies be around trade, immigration, fiscal policy, and regulatory policy? How will those things shape up? None of us really know right now. And we do anticipate that that uncertainty will weigh on activity to some extent, and that will help push bond yields a bit lower over the course of the coming year.
Mark, what's the bigger risk factor here going forward as you look ahead to 2025? Is it what the Fed does, or is it more so what's coming from the incoming administration and what those policies look like?
Yeah, well, look, fixed income investors are going to be ultimately responding to the data as it comes in. The Fed is extremely important in terms of how it impacts bond yields. But the Fed is ultimately going to be determined by the data, and the data will be heavily influenced by the economic policy set that we get as well. Right now, I think that the market has a pretty good understanding of where the Fed is and has a very good understanding of where the economy is. But the big question mark is, what are we going to see in terms of those economic policies? And right now, that's where we strongly sense the market's focus is at the moment.
It's a really interesting backdrop, Janet, and I'm curious from your perspective if you can talk about where you see the most opportunity within fixed income. You talk about in your notes you sent over that this is the environment where active management can add value. Why actively manage when you can just sit in the 10-year and get 4% yields?
Yeah, if you start at the top, certainly it's an attractive time, we think, for fixed income investing because yields are higher than they've been in quite some time. If you go back to, for example, January of 2021, quarter of all global public bonds were trading with negative yields. So we're at a point where almost 90% are trading with yields greater than 2%. So we think now is a good time to allocate to fixed income, but not indiscriminately. Certainly, you can allocate to higher quality parts of fixed income to harvest most of that yield. We do think you should still have an allocation to corporate credit, but credit spreads are quite tight. So here we think you should proceed with caution. For example, in investment grade corporate credit, we like the BBB part of the market because we feel that the economy is going to support those types of companies and you get some incremental yield there. In high yield, we think a more measured allocation, tilting your portfolio more up in quality to BBs and shorter duration. And then outside of corporate credit, something like structured product is an area that is quite high quality and gives you some incremental yield. So having an active manager that can help with those allocation decisions, we think is very prudent in a market like today, where portions of it, like corporate credit, are quite expensive.